Imagine you're at a lively cafe, eavesdropping on a heated conversation at the next table. One person is raving about the booming US economy, while the other is bemoaning the downfall of China's once thriving economic powerhouse. Intrigued, you lean in closer, eager to understand this tale of two giants. Today, we're diving into the surge of the American economy and the tumble of China's, with eye-opening data and insightful analysis. Let's kick things off with Evergrande, a major player in real estate, drowning in $300 billion of debt. In January 2024, a Hong Kong judge ordered its liquidation, marking a pivotal moment in China's economic woes. Evergrande's collapse is more than a corporate failure. It represents a broader crisis in China's property market, a sector that makes up about 30% of the nation's GDP. To put this in perspective, Bloomberg Economics estimates that a mere 5% drop in housing prices could erase $2.7 trillion in wealth. And it's not just Evergrande. Country Garden, another big name, is teetering on the edge. This isn't just about a few companies. It's an entire sector, over-leveraged and overbuilt, now staring down potential catastrophe. China's economic growth has hit a serious slump. In 2023, China barely scraped by with a 5% growth rate, the lowest in decades. Analysts predict an even slower growth of just 3 to 4% in 2024. This is a far cry from the double-digit growth rates of the past, signaling that China's economic miracle may be faltering. Multiple factors are at play here: reduced consumer spending, declining exports, and a sluggish property market. Remember, this is a country that once boasted an average of 9.5% growth annually for 3 decades, lifting over 800 million people out of poverty. The current stagnation points to deeper structural issues that simple stimulus measures might not be able to fix. Consumer confidence in China has, quite frankly, plummeted. According to Beijing's National Bureau of Statistics, the Consumer Confidence Index dropped almost 10% from its high last March, now being lower than during the pandemic. This is of course crucial because consumer spending drives economic recovery. In 2022, household consumption in China accounted for just 38% of GDP, compared to 68% in the United States. When consumers lose faith in the economy, they cut back on spending, which slows economic growth. Deflationary pressures make this worse, as falling prices encourage consumers to delay purchases in anticipation of even lower prices, creating a vicious cycle of reduced spending and economic stagnation. If people aren't spending, businesses suffer, leading to layoffs and further reducing consumer confidence. It's a downward spiral that's notoriously hard to break. Deflation is another significant issue, marking the longest deflationary run since the 2008 global financial crisis. Consumer prices fell for 4 consecutive months at the end of 2023, indicating a persistent decline in demand. While falling prices might seem like a good thing, deflation is actually harmful. It increases the real burden of debt, making it harder for households and businesses alike to repay loans. In 2023, China's debt to GDP ratio reached 287.8%, a staggering figure. Rising debt costs can lead to defaults, further straining an already fragile financial system and reducing overall economic activity. The longer deflation continues, the more entrenched these problems become, making recovery increasingly difficult. It's like being trapped in quicksand. The more you struggle, the deeper you sink. Local government debt is another looming crisis. Many local governments in China have accumulated massive off-balance sheet debts, primarily through financing vehicles used for infrastructure projects. These debts have ballooned as local governments relied on land sales for revenue, a revenue stream that has now dried up with the collapse of property giants like Evergrande. The inability to service these debts could lead to widespread defaults and utter financial instability. Local government financing vehicles, LGFVs, are estimated to have accumulated debts equivalent to 40% of GDP. This clearly unsustainable debt level poses a severe risk to the broader economy and could trigger a financial crisis if not addressed promptly. Imagine trying to run a city where your primary source of income, land sales, is suddenly worthless. China's demographic challenges are another critical factor. The country's working-age population is shrinking and birth rates have hit record lows. In 2023, China's birth rate dropped to 6.39 per thousand people, a significant decline since 2016. In 2022, deaths exceeded births for the first time in decades, resulting in negative population growth. An aging population means increased spending on healthcare and pensions, reducing funds available for economic development. Moreover, a smaller workforce hampers productivity and economic growth. This demographic shift also leads to a smaller consumer base, which further dampens economic activity. This demographic time bomb threatens to slow China's long-term growth prospects significantly. It's like trying to run a business with fewer and fewer customers every year. Eventually, it becomes unsustainable. Externally, the environment is also challenging for China's export-driven economy. Global supply chain disruptions, trade tensions with the United States, and slowing worldwide growth have hit Chinese exports hard. The Red Sea crisis, for instance, disrupted a vital shipping route, causing delays and increased costs. Approximately 60% of China's exports to Europe pass through the Suez Canal, and disruptions there have significantly impacted Chinese exporters operating on already thin profit margins. Additionally, over 70 countries, including major economies like the United States, Russia, and India, have either held or are preparing to hold elections in 2024, creating further uncertainty in global markets and posing additional risks to Chinese exports. When your business model relies heavily on exports, these global issues create a storm that's hard to weather. China's over-reliance on an investment-driven growth model is proving unsustainable. The country's investment rate is a staggering 42% of GDP, much higher than other economies, which average around 18 to 20%. This overinvestment has led to significant inefficiencies and overcapacity, particularly in industries like steel and cement. For example, China Railway's debts amounted to $900 billion by the end of 2022, and it regularly fails to generate enough revenue to cover its costs. The infrastructure sector is burdened with underutilized assets and diminishing returns on investment. Such high levels of investment are not translating into proportional economic growth, indicating deep-rooted inefficiencies within the system. The banking sector in China is severely under strain too, heavily exposed to the property market. Chinese banks have around 70% of their assets tied to real estate. This means that if housing prices fall, these banks face significant losses. Bloomberg Economics estimates that a 5% decline in housing prices could result in a $2.7 trillion loss in wealth. This potential loss would have devastating effects on the banking system and the broader economy. Already, dozens of property developers have defaulted, and the pressure on banks to cover these losses is immense. Lower bank deposit rates and a lack of attractive investment opportunities have left Chinese consumers poorer and more cautious about spending. Banks are supposed to be the backbone of the economy, but what happens when that backbone starts to break? Political and policy decisions are exacerbating China's economic woes. President Xi Jinping's focus on national security and technological self-sufficiency over economic growth has led to several missteps. Policies like the 3 red lines have tightened credit conditions, exacerbating the property market downturn. These regulations, intended to reduce financial risk, have instead caused significant liquidity issues for developers, further destabilizing an already destabilized property sector. Additionally, the prolonged zero-COVID policy stunted economic activity and shook business confidence to its core. The combination of strict lockdowns and mixed messages about economic priorities has left many businesses hesitant to invest and expand, leading to lower economic output and growth. The government's attempts to balance economic growth with political control have created a climate of uncertainty and fear, stifling innovation and investment. So that's the current outlook for China. Now, let's switch gears to the American economy, which is experiencing a remarkable surge, outpacing its G7 counterparts with the fastest growth rates in the G7. The US economy expanded at an annual rate of 3.3% in the final quarter of 2023, exceeding many analysts' expectations of 2%. This performance is a testament to robust household and government spending, reflecting the resilience and dynamism of the economy. Over the entire year, the economy grew by 2.5%, up from 1.9% in 2022, showcasing a year characterized by unexpected economic strength despite significant challenges such as rising borrowing costs and cooling inflation. America's economic dominance is further highlighted by its substantial contribution to the G7's GDP. So in 1990, the US accounted for 40% of the G7's nominal GDP. Today, it makes up 58%. This increase is also notable in terms of purchasing power parity, or PPP, rising from 43% in 1990 to 51% today. This economic outperformance translates into tangible wealth for its citizens. In PPP terms, income per person in America is now 30% higher than in Western Europe, 54% higher than in Japan, and a whopping 241% higher than in China. Such statistics underline the prosperity generated by the American economic model, characterized by a higher fertility rate, a more open immigration system, and significant productivity growth. Since the end of 2019, America's economy has grown by about 8% in real terms, outstripping the euro area, Japan, and Britain, which saw far more modest expansions. This growth trajectory indicates that the US is the only large economy to have returned to its pre-pandemic growth trend. This remarkable recovery is attributed to a number of factors, especially effective domestic renewal policies and successful coalition building, which have bolstered the economic landscape. The US economy is also predicted to be larger in 2030 than forecasted before the pandemic, underscoring its robust long-term growth prospects. A critical factor in America's economic success is its productivity. From 1990 to 2022, American labor productivity increased by 67%, compared with 55% in Europe and 51% in Japan. Additionally, Americans work an average of 1,800 hours per year, significantly more than their European counterparts. This productivity growth is partly due to increased investments and advancements in technology, reflected in the rise of total factor productivity, TFP. This measure, which excludes the effects of capital and labor, shows enhanced efficiency and technological adoption, cementing America's position as a global economic powerhouse. Despite its economic prowess, the US does face significant challenges, particularly in terms of income inequality. The earnings gap between the rich and the poor, although stabilized somewhat by a tight labor market in recent years, remains a pressing issue. Recent pay increases for low-wage workers have helped bridge some of this gap, but disparities between top and middle-income earners persist. Moreover, the US has the most unequal income distribution in the G7 after taxes and transfers, highlighting the need for policies that can address these socio-economic disparities without stifling economic growth. The broader global context also plays a role in America's economic boom. While the US thrives, China's economic growth is slowing, hampered by weak domestic and international demand, falling exports and imports, and a significant contraction in the workforce. China's GDP growth is predicted to slow to just over 4% annually by the end of this decade, a stark contrast to its past growth rates. This stagnation in China's economy, coupled with increasing geopolitical risks and state intervention, has led global businesses to seek alternatives, further strengthening America's economic position. The economic narratives of China and the United States couldn't be more different. While China grapples with a real estate crisis, deflationary pressures, and a shrinking workforce, the United States enjoys robust growth, driven by strong consumer spending and high productivity. The divergent paths of these two economic giants offer valuable lessons in economic management and resilience. As China faces the challenges of restructuring and reform, the US continues to build on its strengths, setting a benchmark for economic success in a complex and ever-changing global landscape. The comparison between these two economies not only highlights their current states, but also underscores the importance of adaptability, innovation, and sound economic policies in navigating the future.